Following a big week that's been dominated by talk of tariffs, with Donald Trump enacting a 25% tariff on autos that aren't built in the US, that focus is only likely to get intensified in the week that is going to be dominated by so-called Liberation Day on Wednesday, the payrolls on Friday, inflation coming out of the eurozone, the RBA interest rate decision, and more. Expect more volatility, and we're going to take you through all of it within today's show. As ever, let's take you through the big ticket items according to Trading Economics. We're kicking off on Monday with the PMI numbers coming out of China. Of course, absolutely crucial at a time when there is a feeling that Donald Trump could be more positive towards China than people had previously speculated. But, that remains to be seen. Certainly at the moment, there's talk of him possibly lowering tariffs in the event that they can get TikTok off the Chinese. So Chinese manufacturing, but also the non-manufacturing. We've got inflation coming out of Germany that comes off the back of a reading from Spain and from France that we've just seen on Friday, and leads us into Tuesday's inflation report from the eurozone. We've also got the RBA interest rate decision taking place that day, the Caixin manufacturing PMI out of China. So continuing that theme, ISM manufacturing PMI, that's going to be a particularly important one. The job openings kick us off on the pathway to Friday's jobs report, where we've got, of course, the likes of the jobless claims, the ADP payrolls, and then Friday we've got the jobs report out of the US and out of Canada. Massive week, but in the middle of this, whilst we don't necessarily even have a Wednesday because they don't have any big ticket items, despite the fact that the ADP payrolls is on that day, we've also got the so-called Liberation Day, or the reciprocal tariff day, which takes place on the 2nd of April, which is the Wednesday. And that's, of course, going to be likely the big ticket item. I'll try and put together a separate video for that, but we'll cover it a little bit. So let's kick off with the US. So this is the sort of docket of big ticket items for the course of the week. And there's a huge amount to get through, really. Like I said, the ISM manufacturing and services PMI numbers are going to be really important. So I'll show you exactly why, but we've been seeing an uptick in terms of inflation pressures in manufacturing, but downward pressure in terms of services. Now, it comes off the back of a core PCE price index report that saw exactly that, easing shelter prices and services not necessarily as much of a problem after years of it being a problem. And instead, we're seeing manufacturing and goods inflation starting to tick higher in anticipation of the tariffs that are going to be enacted by Donald Trump. Of course, then we have that focus on the employment sector. So Monday, we see the employment metric within manufacturing. That's going to be important. We get the ADP payrolls figure coming out on Wednesday. On Thursday, we're going to see the jobless claims, and we also see that ISM services PMI. So we see the breakdown within that. So look out for the prices paid element, but also the employment element. And then on Friday, we've got the jobs report, which is topped off by an appearance by Jay Powell to round off the week. And like I said, we've got Liberation Day taking shape on Wednesday, which sees him essentially take aim at the supposed dirty 15. Those are the countries that hold a trade surplus over the US. And, it's not to say that you're dirty if you have a trade surplus, because that's essentially with the position that Donald Trump wants to be in against all of the countries around the world. But nonetheless, many of these have tariffs and trade barriers that might benefit them, that he would look to essentially implement in turn back at that same country. Of course, this chart shows you exactly the kind of countries that are going to be coming into focus. China, by and large, we already know that they have been taking steps against China thus far, but more so some of these other countries, Mexico, Vietnam, South Korea, the eurozone story continues to play out. Canada, of course, already have been in the limelight. So it does highlight the kind of areas where we could see some volatility. But what's notable over what we've seen over the last week is that when we saw the enactment of the autos tariffs, 25% across the board, we saw weakness both home and abroad for US companies. We saw weakness for the likes of Ford and General Motors. And that highlights the fact that businesses within the US aren't necessarily all going to suddenly rise as companies abroad fall, because many of these businesses might get hit with a tit-for-tat trade war. Many of these businesses might be importing goods from other countries as a part of production, and therefore their costs are potentially going to rise going forward. Talking of prices rising, well, it's goods inflation that is a problem at the moment. Now, we've seen the core PCE price index moving upwards, but we're still relatively subdued, sort of in consolidation mode for the last year and a bit. But you can see here the Philly Fed, the ISM Manufacturing, and the Empire State all seeing the prices paid elements moving towards the upside in a fairly rapid manner recently. And that's why the ISM Manufacturing PMI figure is going to be really important. So keep an eye out for that gauge, in particular the prices paid element, because with the core PCE price index coming out and essentially signaling that goods inflation is starting to rise, so the ISM Manufacturing PMI prices paid element tells us that story, but in a sort of leading indicator. So keep an eye out for that alongside the services PMI to give you an idea of the direction of travel for inflation going forward. Then, of course, on Friday, we've got the jobs report. Now, I'll put together a separate video for that, but this is just one thing that I wanted to bring to your attention. And what it is essentially the ratio of job creation that is down to government hires, right? And so historically, what you've seen is that during periods of crisis, so those grey sections, recessions, you see the government ramping up hiring and the private sector essentially eases back on hiring, right? So they're trying to soften the blow. What's notable is that under Joe Biden, we saw this figure rising. And so alongside that, you can look at the bottom section, which is the non-farm payrolls change, and you can see that the periods when previously we saw that figure rising, it was the time when we were seeing a collapse in terms of payrolls and then a recovery. So generally, as you see that sort of government percentage rise, you see the recovery in terms of the payrolls figure. Well, this time around, it's been quite different because the payrolls figure spiked and it's been easing off since. But then you see those government roles on the rise relative to wider job creation. So it does point towards a possibility of weakness in the jobs market going forward if we see Donald Trump pulling back heavily on government hiring, which looks to be the case. So keep an eye out for any weakness in terms of the payrolls. In particular, look out for the breakdown in terms of government jobs and how they're being impacted. And then beyond that, we're looking at sort of wage growth as a proxy for inflation. By and large, at the moment, you would say that the question marks around the economy and the lack of confidence with consumer confidence dropping off heavily, that might temper demand when it comes to higher wages. So inflation expectations might start to be anchored away from wages for the time being. So people get fearful about the direction of travel for the economy. But then once we see tariffs kick in and you see prices potentially rise, that's when maybe you see an uptick in terms of the wage growth figure, but not necessarily right now. So let's look at our first chart. So the chart we're looking at now is the Dow Jones Industrial Average. Let's go full screen and we can look from a wider context. This is your trend. Very bullish, of course, but more recently, we've taken on a different role. We've taken a significant chunk out of that uptrend, and you can see here, form this double top formation. That points towards a possibility of further downside to come. And so trying to find a bottom within this is always going to be quite difficult. You could state that if you're looking at this as a retracement, you'd be maybe looking at either a retracement of this wider move or a retracement of this swing low before we then set onto this phase. So if that was the case, we'd be looking out at this from a fib perspective and saying, okay, we're back down towards that 61.8. We found some support and we've rebounded. Crucially, though, we're starting to roll over. And so the gains that we've started to see once again look like they could falter. So if you look at this as a retracement, again, let's look at exactly how this is played. So we've come into the 61.8 fib and started to weaken from here. I think given the possibility of a tit-for-tat trade war, let's just get rid of that, sorry. Given the possibility of a tit-for-tat trade war on Wednesday, given the possibility of weakness in terms of the jobs market, we don't necessarily know exactly that's going to happen. But, as we see higher core PCE price index, the possibility of the jobs market being impacted by sentiment, and businesses not taking investment decisions, holding off due to the uncertainty of the tariffs. all of this plays into the same rhetoric at the same time as we're seeing so-called Liberation Day. And if we see a response immediately from some of these countries, because they pretty much know exactly what's coming, if they respond in kind and start to enact further measures in response, then all of it starts to paint a picture of potential further downside for the indices. This is the hourly time frame. So like I said, sort of rallied into the 61.8, starting to roll over, but really greater confidence of the bears being back in charge will come with a breakdown through your 41433 swing low. Next up, let's look at the eurozone region. So this is the breakdown for some of the major events over the course of the week for the eurozone. Of course, Monday we see a focus on Germany, retail sales, inflation coming out. Then Tuesday, you see inflation from the eurozone. That's really going to be the big ticket item over the course of the week. That's really interesting, actually, because the euro weakness that's been playing out over an extended period of time now is really a function of the fact that the ECB have managed to drive down inflation to the point where we feel pretty confident that they're going to continue to ease rates. That may still be the case. And certainly when you're looking here at a forecast of 2.1, we're expecting inflation to continue to head lower. But that continuation of the weakness story comes in the opposite direction of the potential ramping up in terms of debt, with the 500 billion euro spending package on defense being touted. So if you see higher spending, that comes with higher yields, and that comes with a higher euro. If you see lower inflation, that comes with lower rates, and that comes with a lower euro. So you're seeing a sort of battle between the two factors playing out here at the moment. That's why we've seen the euro holding up relatively well, actually, since we've seen that announcement. So let's take you through a couple of key charts here. First and foremost, we've already seen Spanish and French inflation. That accounts for over 30% of the eurozone figure. The French figure came in at 0.8. The Spanish number dropped from 3% down to 2.3. So massive collapse in Spanish inflation. But the French number remained steady, but it's already at 0.8, right? So all of that points towards the possibility of a relatively weak eurozone number. Of course, keep an eye out for that German figure on Monday. Let's see if I can just bring up what expectations are for that. So expectation for that to remain steady. So markets are expecting a decline in terms of headline inflation in the eurozone. And so that would potentially feed into the narrative of weakness for the euro because of weakness in inflation, leads to weakness in terms of ECB rates. And we're coming up in terms of the tit-for-tat trade war with the US. So that's certainly what's worth watching out for. This is a chart we always look at in terms of comparatives. And you can see here the March figure from last year, 0.8%. So this is the peak of the inflation trend for last year. The biggest month of inflation from last year is dropping out. And so that forms the basis of disinflation going forward. You can see here in terms of, say, the 6-month annualized figure, the 11-month annualized, it all points towards further downside for inflation going forward for the eurozone. And finally, we're talking about sort of yields and the impact on the FX space. This is the relationship between euro and, well, we've got euro and US yields. What we want is euro and UK yield. So let's just bring it up live instead and talk about it there. So here we go. This is the chart for euro sterling versus the euro 10-year and the UK 10-year, right? So as we can see here, more recently, the euro 10-year really gaining significant traction. And this is where there's this sort of battle between the argument of, higher borrowing means higher yields because the stability of the eurozone comes into question, versus the additional rate cuts that are likely to come. And you can see here, we've seen the spike, and in actual fact, euro sterling hasn't really gone with it. Euro sterling sort of held back on this, and now we're starting to pull back. So the weakness we're seeing for euro sterling in a way justifies the fact that the pair hasn't sort of moved. But something's got to give, right? Either this holds up here and then euro sterling rallies, or this continues to move lower, and in which case euro sterling looks to be on the right track. Now, if we look from a wider perspective, we can see very clearly that we've got this downtrend in play. This is something we've been talking about for quite a while here. And So you can see that the recent declines really feed into that and point towards a possibility of further downside to continue the downtrend that's been playing out since the beginning of 2023. If we look at, say, the nearer term price action, you can see the pop that we're seeing right now is still part of this narrative. So in terms of this move, you'd need to see a break up through your, that is not the level you want. So it's this level here, 8374. If we break up through that level, then, you know, maybe you could say this is a falling wedge and we're set to push higher, and that's going to then match the moves that we're seeing in terms of, there we go, in terms of the 10-year yield relationship. That is a possibility. But certainly that would necessitate a breakup through this 8374, which hasn't happened yet. So for the time being, this downtrend still remains in play. It's playing into the wider downtrend following the rally into trendline resistance. So look out for the 61.8, which currently has marked pretty much the high of the day, which is at, if we can get to a 0.835. And then above that, 0.836 is the 76.4. Look out for those areas as a potential reversal point here for euro sterling. But certainly if we break the 8374, then it starts to look like we could start pushing back up to trendline resistance. And given that move that we've seen in the relative yields, there's a possibility that we see a move towards the upside. But like I said, this inflation report is going to be key, because at the moment it looks like we could come in weak given the downside that we've seen in terms of Spanish inflation. That doesn't have a heavy weighting. It's only 11% of the final number, but we'll look out for the German figure. And then if we do see a weak inflation gauge, that could continue to move the relative yields lower, and therefore that could provide us with that next leg lower here for euro sterling. But certainly one to follow, an interesting chart and an interesting topic to be talking about. Finally, let's talk about the RBA. We've got the Reserve Bank of Australia up on Tuesday, early Tuesday morning. Expectation that they're going to hold off this time around. No surprises there. I mean, ultimately, we're talking about an economy that is massively reliant on the global economy and global trade, right? And Donald Trump, with everything that he's doing, pointing us in a direction of potential breakdown in terms of the world order for trade. That's particularly poignant for big economies like China that are reliant on trade. And so China, you know, Australia is heavily reliant on China. So Australia at the moment hasn't necessarily looked too bad. I mean, ultimately, we've seen inflation coming down. We've seen the PMIs starting to improve. So this is the relationship between the 10-year yield and inflation. Inflation moving lower, the 10-year holding up relatively well. That comes down to a number of different reasons. Perhaps people think that the inflation level is going to come upwards once again. But also, you could say that it's a relationship of what's happening in terms of the interest rates from the RBA, and essentially they've hiked them and they haven't started to really cut them back yet. So, you know, if we start to see some meaningful cuts from the RBA, then it could start to see this yield rolling over. Like I said, we have seen improvements in terms of the PMIs, and you can see the surge in terms of manufacturing output actually topping out above the services business activity figure. And this is a trend that we're seeing at the moment, really manufacturing starting to come back into strength. But by and large, both of them are in expansion territory. And so it doesn't necessarily mean that the RBA have got all that much pressure on them to act right now, given the question marks about tariffs and the like, and also at the same time that we're seeing strong PMIs coming out. So that points towards a little bit of caution coming into play. That caution is highlighted here, 86% chance, according to Refinitiv, of a rate pause, just 14% chance of a rate cut. Instead, people looking towards May as the likeliest time for that rate cut to come into fruition. That would take us down to 385. Beyond that, you do have markets pricing a strong chance that we see another one or even two rate cuts by the end of the year. So possibly two. Markets, I think, pricing something like 65 basis points worth of cuts over the course of the year. Just not this time around. It doesn't make sense for them to move this time around. One of the charts I always like to bring up when it comes to the Australian economy is Aussie Kiwi. And in part, that's because it sort of shakes out some of the different factors that might play into these different pairs. In particular, you know, Aussie dollar, because you're talking about risk on, risk off sentiment coming into it as well. But what we can see here is that relationship in terms of Australian and New Zealand yields, you know, following each other very well. And so we if we know where yields are going, then we can potentially know where the Aussie Kiwi is going as well. Well, what's happened here is that relative yield has remained relatively low, but we've started to see the Aussie pop towards the upside. So is that pointing towards the possibility of this rally fading because we haven't necessarily seen that for yields? Possibly. And you can see certainly, if we take that off, so it looks a little bit clearer, you can see here that we have got this sort of big double top formation. So that signals the potential that this rally is something that's going to falter once again. Let's just get this and show you the wider context. So you can see that the long-term trend is bullish. Of course, we broke through that support level. The question mark here is, would that retracement be coming from here into a wider retracement? Significant questions coming into play. But if we look at the 4-hour chart, I think it looks a little bit clearer because, as it stands, we're still within this bearish trend. We've come into this sort of deep fib zone. And so if we were to break through your swing low that we have down here, which is 1097, then it starts to look like the pair's going to roll over once again and give back some of those gains, especially given the fact that we are seeing this weakness for that Aussie against the New Zealand 10-year yield, essentially that ratio between the yields. Keep an eye out for what's happening in terms of the meeting. If we see them coming out with particularly hawkish statements, then yes, it could lift that relative yield relationship and lift the likes of the Aussie against the New Zealand dollar. But if they essentially pave the way for easing, but they just want a little bit more clarity for the time being over the tariff issue, market's currently pricing in around 65 basis points worth of cuts over the course of the year. So that would signal the possibility that people start to turn against the Australian dollar and expect further downside in terms of yields, which have held up relatively well thus far. If we see weakness in terms of yields, we're likely to see weakness in terms of the Australian dollar. So a key 3 themes to be watching out for the week ahead. I hope this has been useful. Like I said, I'm going to try and create videos for you guys around the Liberation Day, around the jobs report and all sorts. And alongside this, we'll continuing to create daily content, daily short videos. I've also put together a raft of short educational videos for education of Financial Literacy Month. They're going to be released over the course of the coming months. So plenty to go at, and yeah, it's going to be a big week ahead, to say the least. My name's Josh Mahony, Chief Market Analyst at Scope Market. Have a great day.